All right, so picture that you're in your trading app and like your thumb is just hovering over that buy button.
Oh, yeah.
Right? And maybe it's because a friend told you about this stock that's supposed to be like the next big thing.
Mm-hmm.
Or maybe you just saw some headline that was like huge gains, and is promising these big returns.
Yeah, the promise of riches. Right?
Yeah. And I think we've all felt that little thrill of like the potential profit, like that dopamine hit, right?
It's absolutely that anticipation.
Yeah. But here's the question that I think is really worth asking. Like, in that moment, are you actually investing, or is it something else completely that's like driving your decision?
Yeah, that's the real question, isn't it?
Yeah. And that's like what I really want to get into today, the difference between treating the stock market like it's a long-term strategy versus treating it like I don't know, almost like a casino.
I think that's a great analogy.
Yeah.
Because that feeling you were talking about, that thrill, that's very real. And it's really seductive. And I think it kind of taps into this primal part of our brains. We're always looking for that quick win.
Right.
But it's so important to like step back from that for a second and really analyze what's motivating you to do that.
Yeah.
Because how you approach the market, it really does have a real impact on what your financial future is going to look like.
For sure. And I think when you're operating from that place of gut feelings and hype, you're essentially gambling with your future. And that's what's so scary about it.
Yeah, you're risking your security.
Exactly. And that's why we've been looking at this article called Why You Stopped Treating the Stock Market Like a Casino. And it's all about like that shift in mindset that has to happen.
It's a profound shift.
It is.
Yeah.
And so like our goal today in this deep dive is to really pull out the key lessons from this article, and hopefully it'll help you honestly assess like how you've been approaching the market and how to move towards a smarter way of building your wealth.
I love that. And, the article actually starts off by talking about this really common starting point that I think a lot of people fall into.
Okay.
And that is this idea that simply participating in the stock market means that you're investing.
Okay, so just by like having a brokerage account and owning a couple shares.
Exactly.
You think you're investing.
You think you're an investor.
Got it.
But it's more nuanced than that.
Right. And I think it's easy to get caught up in that. Like, you see a stock, it's going crazy, everybody's talking about it. Maybe it's like constantly on the news.
Hello, right?
Total FOMO, yeah. And you're like, okay, I need to get in on this. And you toss some money in, and maybe you don't even really understand the company or how it makes money or, what their long-term prospects are, but you're in the market.
Yeah. But are you really, though?
And that's exactly what the article says. Like, if you can't explain the reasons why you bought something,
Yeah.
if you haven't done any research, then are you really investing, or are you just kind of speculating?
I think that's a great way to put it. And you're just hoping for the best.
Exactly. You're crossing your fingers.
Right. And I think it comes down to a passive approach versus an active approach.
Okay.
True investing requires you to really roll up your sleeves and do some due diligence and really make a conscious effort to understand what you're putting your money behind.
Yeah. It's about more than just the ticker symbol.
Absolutely.
So that leads us to like the big distinction that the article talks about, which is investing versus gambling.
Right. And I think that's where things get really interesting.
Yeah. And so when we talk about investing, like we're thinking long term.
Exactly.
This is like a very deliberate, and it's often like a slow and gradual process.
Yeah. It's a marathon, not a sprint.
It really is. It involves like actually like looking at businesses and understanding their competitive landscape and setting like these financial goals that are, years, if not decades down the line.
Absolutely. It's about thinking in terms of like 10 years, not 10 days.
Yeah, exactly. And then on the other hand, you have gambling. And the article points out that gambling is all about emotion. It's that instant gratification.
The fear of missing out.
The FOMO, exactly.
Yeah.
And it's like, making these very impulsive decisions that are based on chance rather than like actual fundamental analysis.
And reacting to any little blip in the market.
Yeah, you're just like constantly chasing the next hot stock tip.
Yeah, driven by emotion.
And here's a really important point that the article brings up. With investing, you can actually make informed decisions.
You have some agency.
Right. You can do research. You can look at data. You can develop some sort of thesis about why you're buying something.
You're not just throwing darts at a board.
Exactly. And gambling, it doesn't have that at all. Like once you place your bet, it's totally out of your hands.
You're the mercy of fate.
Yeah. And I think that element of control, or at least like, informed participation, that's really what makes the difference.
I completely agree. Investing is about managing risk.
Yeah.
And gambling is about, accepting pure chance.
So the article actually asks, the reader to like get a little introspective.
Yeah, to check themselves.
Yeah, and there are these really direct questions that are worth asking yourself, honestly. So, like, have you ever bought a stock just because somebody online was, like, really promoting it, or maybe, like, a friend told you about it?
Yeah, without doing any of your own research.
Right. Have you ever invested in a company without really understanding their business model or their revenue streams or, how they actually make money?
Or the potential challenges that they're facing.
Yeah. And here's another one. Like, do you find yourself constantly refreshing your portfolio like multiple times a day and feeling that like rush of excitement or anxiety?
Oh, yeah, I've been there.
With every little price change?
Absolutely glued to the screen.
Yeah. And here's like maybe the most telling question. When the market goes down and the value of your investments drops, like what's your immediate reaction?
You hit that sell button.
Exactly. Do you panic sell?
Yeah, fear takes over.
And the article says that if you're saying yes to a lot of these questions, then your approach might be a little bit more speculation than actual investing.
It's a wake-up call.
And the market is not kind to those who react emotionally.
No, it's not. It rewards the disciplined and the patient.
So if that little self-assessment maybe revealed some areas where you could be a little bit more strategic, the good news is the article gives you some steps to make that transition to real investing.
Okay, so what's step one?
Step one is get real.
I like that.
Like, take a long, hard look at your portfolio. Can you explain what every single one of those companies does?
Can you give an elevator pitch?
Right. And if you find yourself drawing a blank on, like, more than a few of them, the article says it might be time to, like, reevaluate your holdings and think about building a portfolio based on understanding not just what's hot right now.
Absolutely. Knowledge is power.
Totally. And so the second step is learn for real.
Okay, so go deeper.
Yeah, you got to go beyond the hype and actually seek out good information.
So, like, where do you go for that?
Well, they suggest things like reading books about investing, taking some beginner courses, following some financial news sources that are reputable, things that will equip you with the knowledge to like actually analyze companies.
Yeah, and understand those financial
It's-
statements.
Exactly, and really assess like, the long-term viability of a business.
And the article makes a really good point. The more you know, the less risk you're taking on.
For sure. And the third step is ditch the quick win mentality.
Okay, so patience is key.
Yeah, they're saying that real wealth building through investing is a marathon, not a sprint.
We said that earlier.
Yeah, and it's about consistency over the long term, not about trying to get rich overnight.
Slow and steady wins the race.
Yeah, and they have this great line in the article. It's like, fast money fades, slow money sticks.
I love that.
Okay, next is diversification.
This is huge.
It is, and it's not just about owning a few different stocks. It's about spreading your investments across different things.
Different sectors, different asset classes.
Yeah, so maybe you have some ETFs, some real estate,
Don't put all your eggs in one basket.
Exactly, and the idea is you don't need every single investment to be a home run.
Right.
Like, you just need a well-diversified portfolio that can kind of weather the storms.
So if one area takes a hit.
Yeah, the other areas can help to make up for that.
Exactly. It's all about balance and managing that risk.
And then the last step might sound a little counterintuitive.
Okay, let's hear it.
Embrace the boring.
Embrace the boring. Interesting.
No, right? And it's because, we get so drawn to that excitement of those potential quick gains.
Right. It's tempting.
It is. But the article is saying that, like, real investing, it often happens in the background. It's steady. It's consistent. You don't have to be glued to your screen every second of the day.
It's about letting your money work for you silently and steadily.
Yeah, and that can actually be really freeing because you don't have to stress about every little market fluctuation.
Yeah, you can actually focus on living your life.
So the article does acknowledge that the stock market is inherently risky.
Right. There's no such thing as a guaranteed return.
Exactly, but it makes a really important distinction between what it calls smart risk and stupid risk.
So there's good risk and bad risk.
Kind of, yeah.
Yeah.
So smart risk is like making informed decisions, understanding what you're investing in, and not panicking when the market inevitably dips.
Right. It's about having a plan and sticking to it, even when things get a little bumpy.
Exactly. And then stupid risk is basically gambling. It's making decisions based on gut feelings or reacting to news without really understanding it.
Or blindly following the latest trends.
Yeah, and the article is pretty clear that that kind of risk is what often leads to like people losing money.
It's about recognizing the difference between calculated risks based on knowledge and just pure speculation.
So if you're thinking about, okay, what does a real investing approach look like in practice? The article kind of paints this picture.
Okay, I'm listening.
It starts with defining your financial goals. Like, what are you actually trying to achieve?
What's your why?
Yeah. And then it's about creating a plan that aligns with like your time horizon and how much risk you're comfortable with.
So tailoring it to your individual needs and circumstances.
Exactly. And of course, it involves doing your research before you buy anything.
Due diligence is key.
Right. And it's about being consistent even when the market feels like it's not doing much.
Yeah, staying the course.
And really importantly, it's about not selling everything when the market dips.
Resisting that urge to panic.
Yeah. And finally, it's about checking in on your portfolio periodically, but not like obsessing over it every day.
Yeah, finding that balance between staying informed and not getting overwhelmed by the daily noise.
And I love this point that the article makes, which is that the more you understand about investing, the less scary it feels.
Knowledge is power.
Yeah, and it's about like moving away from guessing and towards a well thought out plan. And that's really the difference between gambling and investing.
Absolutely. It's about taking control of your financial future.
And the article wraps up with this analogy that I think is so powerful.
Okay, what is it?
It says that the stock market is not a slot machine.
I like that.
If you treat it like one, you're probably going to lose money.
You're playing with fire.
But if you approach it seriously and you're willing to learn and you create a plan and you have a long-term perspective,
You can actually leverage the market to your advantage.
yeah, it can be a tool to help you build wealth and freedom and security.
Right. It becomes an instrument for growth rather than a source of stress.
And they leave the reader with these two really important questions.
Hit me.
Are you truly investing or are you just hoping to get lucky?
Those are powerful questions to reflect on.
They really are. So to kind of wrap up this deep dive, I think the main takeaway is that there's this really crucial difference between speculating, which is exciting in the moment, and true investing, which is about like this long-term strategic journey.
And understanding that difference can empower you to actually take control of your financial future.
Exactly. And it's about moving away from making decisions based on emotion and fear.
And towards a more proactive approach based on knowledge and a clear plan.
So I want to leave you with one last thought. Now that you've kind of thought about your own relationship with the stock market, what's one tiny thing you can do today
Yeah. One small action.
to move yourself more in the direction of being like a confident, well-informed investor,
Okay. I like this.
rather than just somebody who's hoping to get lucky in the market?
So, like, what could someone do right now?
Maybe it's finally starting that book about investing that you've been meaning to read, or maybe it's like taking an hour to really research one of the companies that you own stock in.
Those are great starting points.
Whatever it is, like just take that step because knowledge is power. And when it comes to building a secure financial future, clarity is everything.
Absolutely well said.
All right, thanks for joining us on this deep dive. We'll catch you next time.
Until then, happy investing.
Bye.
Bye.